Welcome to the Osborne Financial Group Podcast, hosted by Jared Osborne. Join us for expert insights on wealth management strategies, essential tips for securing your financial future, and in-depth discussions on life and health insurance options. Get practical advice for protecting your assets and loved ones, proven strategies for maximizing investments, and real-life examples to illustrate key concepts. Stay tuned for Q&A sessions with industry professionals and actionable steps to take control of your finances and insurance needs. Tune in now and empower your financial journey.
Hello, everyone, and welcome back to episode number 3 of the Osborne Financial Group Podcast. I'm your co-host, Jeremy Wolf, joined by none other than your host, Jared Osborne. Jared, good to see you, brother.
Good to see you, Jeremy. Welcome, everybody.
Yeah, I'm excited to get into this topic today because we were just talking before the show about health insurance, and I've always had a hard time wrapping my head around health insurance. Seems like it's almost confusing by design for whatever reason. Specifically with open enrollment on the horizon, I thought we'd kind of take a little dive into open enrollment. So first off, can you explain like what open enrollment is and why it's important that people even pay attention to this period in the first place?
Sure. So open enrollment is an annual open enrollment. That's what it's called, annual open enrollment. It starts November 1st of every year and ends January 15th. That it used to end December 31st. About a couple of years ago during COVID, they extended the time frame to January 15th. And so basically what that means is during that window, that's your window, kind of like if you work for a company, to enroll into a health insurance plan. The reason, one of the most important things, if you don't do it during that window and you wait after that window, unless you have what's called a qualifying event, you can't get conventional health insurance, individual or family health insurance.
So you're completely locked out.
You're completely locked out unless you have correct, unless you have a qualifying event, which are very specific situations. You can't just say, well, I need health insurance and you're outside open enrollment. You are locked out. You cannot get health insurance, and that can be a problem for people who have pre-existing conditions or develop a condition. So yes, you are locked out.
Interesting. So even through through the open market, you're locked out, or what if you have like private plans that are outside that? It's just you're kind of out of luck. So it's that much more reason why you need to pay attention to this.
Right. So you can get health insurance on the individual or family. For individual, I call individual. I also mean family as well. But you can go to the exchanges. Depending on your state, will determine if you utilize the national exchange, which is healthcare.gov. Or some states decided that they don't want to utilize the, national exchange and have their own exchanges. States like New York, California have their own exchange, and many others. Florida uses healthcare.gov. Whether you go through the exchanges, whether it's the national exchange or the state specific exchange, or you go directly to an insurance company, you still have to have a qualifying event outside of that open enrollment period. So it doesn't matter how you go. Now, if you have a qualifying, like you had group insurance, and you're outside of the open enrollment window and you lose group insurance because you're terminated or you lost your job or you're retiring, that creates a qualifying event. So in a situation like that, yes, you can get health insurance outside of that window. You have 60 days to do that once you lose the coverage, but yes, you are essentially locked out, whether it's private or go to the exchanges.
Yeah. So if you miss out just because you weren't paying attention, you're out of luck. But if there's an outside extenuating circumstance that causes you to miss out, you got that 60-day window. And this is why it's so important to have somebody like yourself that has the knowledge about this. Because like I said, it can be so confusing and overwhelming for folks generally. What are some of the factors that folks should consider when selecting a health insurance plan during open enrollment?
Yeah. So there's many, but there's about 3 or 4 or 5 that are essential, or you have to look at. First of all, every health insurance carrier has a network. Okay. And some are skinnier or less robust than others. Okay. Really, it's actually a big factor on the cost of your insurance. The more robust networks, down in Florida would be something like a Florida Blue Options, EP or PPO. They're the most expensive plans. And the reason for that is not because the benefits are any better from if you compare an apples to apples, but because the network is so much larger and it's a national network on some of those plans. So network, you want to be able to see the doctors, your doctors. Sometimes not, if you have a lot of doctors, you may have to decide, hey, 3 out of 4 of my doctors take, whatever, Cigna, whatever, but it's the right plan, so you may have to just go with that plan. There's no guarantees that every one of your doctors will be on the plan that you want or the carrier, and so that's a big factor. Second, obviously, is the cost, okay, or that probably is the first, if you're looking at most people look at, and that's a tremendous factor, because health insurance these days is very expensive. Now, if you are able to qualify what's called a subsidy or a tax credit, that's can also be that's a factor. And
so like based on your income bracket, like if you're in a lower income, you get more tax credits. You essentially get health insurance for free to some degree. The lower income,
it's
subsidized
by the government, a tax credit or a subsidy. And it's income, it's family size, there's a lot of different factors, but really the main factor on getting a subsidy is your income and family size. Those are the 2 main factors. Okay. So network, cost, obviously. Then you want to look at, and third, is the benefits.
Well, but back up a second, if you could, Jarrett, just so I have a clear understanding. Yeah. When we're talking about cost, there's two things here. There's the premium, and then there's the deductible for the plan, right?
Where that goes into the benefits, right? So,
you were getting to that, okay?
Right. So, well, yeah. I mean, it's kind of so the cost when I'm talking cost, I'm talking just straight premium. What is this going to cost?
Premiums, yeah.
Right. Then when you talk about benefits, yes, deductible is everybody for most part knows what a deductible is. That's first dollar. That's typically like you go to that major situation, even some minor things now you're subject to the deductible. The higher the deductible, just like auto insurance or anything else, the lower the cost. It's still pretty expensive these days. And so obviously, you have more exposure. If you're a person that has some pre-existing conditions that you're going to go to the doctor, the unknown. I always tell people they'll call me or they'll say, hey, I'm very healthy. I barely go to the doctor. And I usually say, look, barring the unknown, which is a major claim, I would say go with the middle of the road to higher deductible because, save yourself on premium. If something happens, well, you save premium and you have to come out of pocket. If you're somebody who, has some pre-existing conditions, who, goes to the doctor or has a planned, procedure, you're getting a knee surgery in 3 months. I always tell people, look, the unknown, which is not the unknown, the variable situation where you're going to have a claim or you're going to the doctor a lot because you have some issues. Go with a lower or middle of the road deductible because you're going to use it, and so it depends on the person or the family how they utilize insurance. But yes, benefits, deductible, co-payments. There's something called co-insurance, which I can get into a little later. Or not.
This is a deep rabbit hole. We might have to do more specific episodes on some of this.
Correct. And so also, just going to back up, when you talk about tax credits, there's also when you go to and when you get a tax credit, by the way, or you're eligible for a tax credit or a subsidy, you have to go to the exchange. You can't go directly to Florida Blue. I'm just using them as an example. And say, hey, I want to, they're going to basically say, okay, you can call Florida Blue. They're going to say, we're going to have to go to the, I'll take you through the healthcare.gov, to the exchanges. Yeah. Because you have to go through the government, obviously, to get that subsidy from the government. You can't go direct to if you go direct to the insurance company, they're going to say, okay, I'll take you through the process and we can get you Florida Blue on the exchange, but you have to go through the exchange. And also it's not just, they're going to really get into some personal stuff, your income, how many dependents you claim. If there's things when you're divorced or if you're getting alimony, they're going to look at prior coverage. They're going to look at all these things, and they, healthcare.gov and some of the exchanges will actually make some recommendations on, if you want to really get specific and put in what medications you take, it'll filter it for you and say these plans may be good for you. So it's a healthcare.gov is, as long as I would say you could do it yourself, and I'm not saying this just because I'm an agent and it's my job, but it really is, it could get confusing. And I always say, you don't pay any more or any less utilizing.
You're answering all the questions that I had for you. I was just going to say, the first thing I was going to say is like, can somebody just go and do it themselves? I'd imagine they could, obviously. But then what would be the drawback to having a professional? Because like you just said, there's no additional costs, right? Don't you get paid on your end from not the consumer, from the policy, there's really no disadvantage to finding a licensed professional to help you.
Absolutely.
In fact, you'd be kind of crazy to do it on your own unless you have an extensive knowledge of health insurance. Like, why go through that stress when you can have somebody like yourself walk you through the process and explain everything and make sure that you have a plan that's customized for your specific needs and what you're trying to accomplish.
You're absolutely right, Jeremy. And a majority of the calls I get during or after, typically after, and it's usually too late, is, I can't believe I signed up for this. Nobody takes it, or my medication is not on it. So you really, you got to take some time. If you're a healthy, person and you just want, hey, I want to go to my physical, and we can get you something, as long as I would point you in a certain direction, something with probably higher deductibles, maybe something, a carrier that has a lower cost. But if guaranteed, if you're somebody that has pre-existing conditions or needs specific coverage, you need to see specific doctors. Yeah. I mean, you need to speak with an agent, whether it be me or somebody else, like talk to an agent, because, it really also Florida Blue, there's all different plans and networks. There's EPOs, there's PPOs, there's point of service, there's HMOs. You need referrals. You don't need referrals, so really, you talked about it. It's confusing. And then, you're not, this is not something that you do or the person does who's calling me, and it's a different language to them, really, So
yeah, I want to get into, sorry to cut you off there.
Yeah, no worries.
You mentioned HMOs, PPOs, EPOs. Mm-hmm. What are some of the key differences behind these? Because I've heard all of them before. I've had various plans. I've had PPOs, I've had HMOs, but if you asked me to kind of go in and explain what the differences are, I'd be lost. So Can you maybe clarify for the average listener some distinctions between these different types of plans?
Yeah, no problem. So I'll go between a PPO and HMO. And a PPO is going to cost you typically more, because a PPO, there's no
you don't need a referral, right?
Yep.
For the
no
doctor.
referrals.
You go straight to the doctor.
Correct.
Okay.
And there's typically out-of-network benefits. Okay. Now, those out-of-network benefits are going to cost you a lot more. Typically, the deductibles double of the in-network deductible. The out-of-pocket max, which is your total exposure, including your deductible and copays, is typically double. But you have that flexibility. So if you want to go to a doctor that doesn't take your insurance and you have a PPO, you can do that. You'll pay more, but you have that option. So you have flexibility. The PPO also typically have larger networks compared to an HMO, typically. So when you look at, again, I'll use Florida Blue just because it's the most popular, it's the biggest carrier in Florida. Yeah. If you look at Florida Blue and you look at their PPO or EPO compared to their HMO, the network is a lot more robust with the PPO, and hence one of the reasons why you're paying more for it. Okay. Even when you compare a higher deductible PPO to a lower deductible HMO, the PPO typically, PPO with the higher deductible, even with the lower deductible, the higher deductible is going to cost you more. Okay. Because the network, the reason why you see a lot of these cheaper plans, and I'm not going to get into which ones are cheaper, but there are certain carriers that are cheaper, is because the network is limited. Okay. And why is that the case? Is because typically the insurance company and the provider have a negotiation, and they say, you know what, if you want to be a provider on our insurance, this is your negotiated rate. And they're typically a lot less than the PPOs or the larger, more robust network carriers. And that's the reason. So, so when you compare it to an HMO typically, not always, you need referrals, but an HMO, unless there's an out-of-network HMO, which is more on the group side, individual HMOs, if you don't need a referral, you have to stay within the network. Okay. So if you can't go out of network. Okay. And, down here in Florida, if you get a Florida plan, they're pretty much only Florida. And sometimes they're even just specific areas in Florida. Like, that's how skinny the network could be. It's like, you can't just use, it's not just Florida. It's like, you can only use this state in certain counties. Okay. And so that's another factor where you have to look at, like, oh, I travel a lot. I may need a doctor in, North Florida. Well, you know what? This carrier doesn't have a network there, so that's another factor. So an HMO, they're typically going to be less expensive. You typically need referrals. You have to stay within the network. PPOs, they're more expensive, larger networks, out-of-network benefits, no referrals needed. Those are the main differences between.
Yeah. So I could see that playing a big factor for having more catastrophic claims where, let's say, you get diagnosed with cancer, God forbid, or something, and you're in an HMO with a limited network, you're going to have a hard time going to like the best cancer. Just imagine you'd have a hard time seeing the best cancer doctors in the country. Whereas if you had a PPO with a more extensive network of doctors, you can kind of pick and choose where you'd like to go to some degree, right?
Absolutely, to 100% agree. Yeah, there's no doubt, and so that's a big factor. That's a big factor.
So are there any recent? I know they're constantly adding things to the health codes and open enrollment. Are there any recent changes that were implemented prior to leading up to this next open enrollment period? Not people that people should be aware of.
There aren't. There's been some changes to Medicare. We'll talk about that at a different podcast. But really, I don't even know right now. Like, if someone said, "Hey, I want to see what it's going to cost me," I get a lot of calls where, like, unfortunately, like, I'm getting divorced. I need to know. I have to tell the attorney what health care is going to cost me. My husband or my spouse is going to have to cover that. What will it cost me? I'm getting divorced in January of next year. That's or I'm getting divorced next year. And the issue is, until probably next month, August, September, I don't even know what carriers are going to be offering. Now, it's been pretty consistent that the carriers that have offered coverage have been pretty consistent on the exchanges over the past 3 or 4 years. But there are companies that not only, if they come off the exchange, maybe they won't, but they'll say, we're not offering these plans anymore. Our whole lineup of plans have changed. The rates always change, and typically not for the better. How much they go up is, last year wasn't crazy. I think it was 10, depending on the carrier. But there are some carriers I haven't seen a decrease in premiums in a long time. I've seen some leveling out, maybe a 5% or 10, but typically it goes up every single year. And I think this year it's going to go up even more from what I'm hearing. So, for those who don't get a tax credit or subsidy, get ready to pay more. I mean, unfortunately, a family of 3 or 4 or 5, decent coverage, it's essentially a mortgage now. I mean, you're paying anywhere from, $1,500 to up to $3,000 a month for health insurance these days. And it's
rough, right? And for a family that doesn't typically utilize the service, it's a tough pill to swallow, right? It's a lot like life insurance, right? You're right. You're betting against.
You need it. There's nothing you can do.
Yeah.
And really, I enjoy one of the aspects of the job of my job, of owning an insurance agency is kind of like figuring out things and looking at ways to help people save money without sacrificing benefits. It's like, it's hard to do that in health insurance because, everybody, I get a call. I want really good insurance with low deductibles, but inexpensive. It's like, I want to eat it too. Cost of a Honda, it's not happening, there's no real, there's no real magic pill that you can, that it is what it is, and you have maybe 6, 7, 8 carriers, and either you're going to take a higher deductible or limited network and, try to save a few dollars and it's still expensive.
Yep.
If you get a tax credit or a subsidy, or you're going to pay it. You have to pay it. I mean, me, myself, as a family of 4, I pay the same like, I don't get a subsidy. I have coverage. I spend a lot of money, and I it's what I do for a living. You would think, and people are like, oh, you can't. No, I mean, I have to pay the same as everybody else. It's not like I'm getting, some special carrier that's going to offer me, I have to pay this. Now, there are some carriers out there or some things, that are a little bit, outside the box of thinking, and they're not bad, but they're very specific for very specific type of people. Like if you're very healthy, there are some carriers out there that offer coverage that you can get that don't cover pre-existing conditions. So for young people, there are some ways around going to the exchanges, but there are some caveats to that. But I do a lot of it, and so there are some other options out there, but for very specific situations. It's not for everybody. So, but back to my point, it's really, unfortunately, there's no magic. There's no like magic bullet, like where you can say, hey, I know this can, usually. And there's also a lot of scams out there. You got to be careful. There's a lot of companies out there that'll call you and say, I get this, you can get this company, and I'm not going to say the company specifically, but there's one or two companies out there that they have phone centers, and I typically get about 2 to 3 calls a month. I have this, I got this carrier, and like going back to the beginning, most people, they hear health insurance, they hear a good pitch on the phone, low deductibles, copays, and they hear price. And then they get it, and then when they utilize it or need it for something major, they're like, "Oh, sorry, this
is not what I thought it would be.
It's not what I thought it would be, or the doctor, you don't have this coverage, or it's a limited, benefit on this coverage." And when you're outside of open enrollment, Jeremy, I usually have to say, "I'm sorry, you're at your FOL." It's
yeah. This is why I love what you do, being a specialist in health and life insurance and also wealth management and financial advice, because these things all work together. And to have an overall picture of somebody's situation and what their goals are, you can kind of, I'd imagine, tailor all these different strategies to be the most effective for them. I wanted to ask you also about health savings accounts and flexible spending accounts.
Okay. Well,
what are those and how do they play into this?
Well, flexible savings accounts are more on the group level, so we'll save that for more with the group. HSAs, I have an HSA. I'm a big proponent of HSAs.
Like now, what is an HS? Like what?
Yeah,
what
an HSA stands for a health savings account. Now, the health savings account isn't when you say HSA, that just has to do with the account, hence the name health savings account. There are specific plans, HSA-qualified plans, that you have to get in order to open an HSA or a health savings account. Okay. Now, the thing about HSA qualified plans is because what an HSA allows you to do is put money pre-tax into an account. If you're a family, you could put $8,300, next year. And if you're an individual, it's $4,150, $4,150. You could put that into an health savings account, an HSA. You can set these up. Fidelity has them. United owns a company called Optum. You can go to optumbank.com. That's what I have. And what it allows you to do is put money into this account pre-tax, and meaning that, you put $8,000 in, let's just say, that's, you pay no taxes on it as long as, and the money that you pull out is tax-free because you can invest it depending on where you go. If you go to Fidelity or Optum, you can actually put it into mutual funds and stuff like that. And if you have any growth, if you pull it out for a qualified medical expense, it comes out tax-free. Okay, now, the great thing about it is there's not many things in this world, and there's books written on this, and as a wealth manager, this, gets me excited. It's kind of scary that this stuff gets me excited. It's pre-tax. I mean, how many things can you put money in pre-tax, gross tax-free? There's not much.
But you said when you take it out for health expenses,
as long as you use for health expenses.
So if you pull it out for non-health related expenses, then you got to pay.
Correct.
Then you got to pay
it's
the
taxes and penalty. Okay. Now
penalties. Okay.
Now, and you have to make sure you have an HSA qualified plan. Now, the one thing about them is they're great because, especially for people, for people who have the means to put that money in. Okay. But the plans are pretty much, except for preventative, which is covered at 100% regardless of the plan. That's an ACA or Obamacare mandated, your preventative is covered 100%. Everything is subject to the deductible, even prescriptions. And typically they're higher deductible plans. So, $3,000 or $4,000 or $5,000, $6,000 deductibles. And pretty much everything is deductible except for preventative. And why is that? And the reason why that is because you're getting this tax break, okay, on the monies that you put in. If you get an HSA, and they're typically cheaper plans because of that. But if you get an HSA qualified plan and don't open an HSA, don't do it. Like, there's no reason to get an HSA qualified plan if you're not going to utilize and open an HSA or health savings account, because the plan is a dumbed down, high deductible plan. Even prescriptions are subject to the deductible. Okay, so you got to be careful. But if you do want to know, they're great. I mean, I have one. Been putting money in. I have a family putting money in for many years. I have a good chunk of change. There's actually, and I believe this isn't necessarily what people do, is pay for your medical expenses out of your pocket, meaning that, yeah, if it's subject to deductible and it's $1,000, pay it out of pocket if you can, and let that money in that HSA plan grow. Because as a young person, unless you're a sick person, as a young person, if you're doing this in your 30s or 40s or even 50s, and you are able to accumulate a few bucks in that account because you're putting money $4,000 or $8,000 in there every single year, and you can accumulate $50,000, $60,000, $70,000, $80,000 in there over a period of time. When you're older, you're going to need healthcare a lot more. As a matter of fact,
okay. So what you're saying is you can accumulate that, and then basically that will pay for all your medical.
Not only medical expenses when you're older, long-term care premiums if you have a long-term care, Medicare premium. Yes,
savings for future
savings that you're getting tax benefit for, and
tax-free.
And as a wealth manager, statistically, one of the biggest expenses when you retire is healthcare. Okay, and they say you're going to need anywhere from $250,000 to $300,000 in healthcare costs, including premiums and Medicare supplements or Medicare Advantage plans, and all these things that you're going to come out of pocket for. When are you going to come out of pocket? Are you coming out of pocket more when you're older for healthcare expenses or when you're younger? Typically, when you're older. And those costs are going to be a lot more than when you're younger. I mean, I'm generalizing, but 9 times out of 10, most people are going to incur more costs when they're older for healthcare than they are. So you're getting these tax benefits now. If you can let that build up, don't utilize the money inside there. I mean, this is just, my opinion. I think it's, there's, like I said, you can Google it. I mean, there's wealth managers that write books on this stuff,
So question for you. So let's just say, hypothetically, you have a health saving account, and you have $50,000, whatever it is at the end, and you end up not using that, and then you pass away. Could those funds then be used for final care expense, like funeral, burial, and all that, or is that a totally separate thing?
So first of all, once you hit Medicare, you can't contribute to an HSA anymore. You can, and also to back up a second, it's a good question. Even if, let's just say you decide, you know what, I want a rich plan this year, or I'm in a group plan now, and I don't have an HSA qualified plan, but I've incurred all this money in this HSA account. You can't contribute anymore because you don't have the plan tied to it, but you can utilize the funds. So that's one thing. Just because you don't have an HSA qualified plan doesn't mean you can't use the funds that you've
for another plan that
for whatever. Yeah, for any. You're right. So you have 10 grand in the HSA. You go to a non-HSA qualified plan, and you incur some expenses, or you want to utilize the HSA money in there. You can certainly do that, even if you're not contributing or you don't have a qualified plan. So that money is always yours. It never can be taken away, even on a group level. If your employer, sometimes employers will contribute a little bit to your HSA account if you have an HSA qualified plan. If you leave the company, that money is always yours. Always yours. And that kind of is the difference between an FSA. An FSA, if you leave or you don't use it, you lose it. So just to kind of give you an HSA, if you don't use it, doesn't matter. It's always yours. Always, always. And so if you are older, you can basically, what happens is if you don't use it, if you die, it goes to your family at that point, and they can pull it out. You will have to pay taxes on it at that point.
And penalties?
Yeah. There's no penalty, because it's like a beneficiary. It's kind of like an IRA. It just goes to whoever, but you will have to pay taxes. And if you use it when you're 65, and you don't use it for qualified medical expenses, you can still use it, but you have to pay taxes at that point. Okay. So, yeah.
There's, like I say, a lot to digest there.
Yeah.
Hopefully our listeners got some useful information out of this, but if you take one thing away from this conversation, it's speak to a trusted advisor that has a background that's licensed to do this, because like you said, there is no downside to doing it. It's included, like you don't pay for it. So you might as well go and sit with you and have you go through somebody's situation and craft a plan that makes the most sense for them.
Absolutely.
100%. So.
And quickly, yes, that would be the biggest takeaway. And again, I'm not saying this because it's my job, but I get more calls on I did it myself, and also, we have to go through specific training as an agent, to get, to even offer insurance on the exchange. We can't just say, hey, I'm an agent. I have to actually train every single year, go through a training program. So, and I've been doing this since the, beginning of Obamacare. So yes, definitely utilize somebody and make sure you try to get somebody that is, referred to you or you've utilized them in the past, because there's a lot of agents out there that, don't know what they're doing, or they're new agents. And I hate to say this, but they're agents for 6 months and they leave, and then you can't get in touch with them after. So, try to find somebody that has some experience doing this. When you're talking about healthcare, you don't want to mess around. There's a couple of things that, you just want to make sure that you get somebody you trust, or that, will be there, in a month or 2 or 6 months or a year. So yes, that's the takeaway.
For sure. So if you're out there listening and you're feeling in the weeds, maybe you're unclear on some issues, if you have any questions, or if you have anything to share, comment below, reach out to Jarrett anytime. He has a wonderful team. He's happy to help you through this process and answer any questions that you may have. Jarrett, always a pleasure, brother. Have a wonderful 4th of July. And I'll catch you on the flip side.
Happy 4th of July, everybody. Thanks for joining us, and hopefully we'll see you next month. And give me a call or shoot me an email if you have any questions or need anything.
All right, sounds good. Thanks everyone for joining, and have a wonderful day. Take care.
Thanks, Jeremy.
Bye.
Bye-bye.
Thanks for tuning in to the Osborne Financial Group Podcast. For more financial tips and personal advice, visit us at www.osbornefinancial.com. That's www.osbornefinancial.com. Or give us a call at 954-963-3300. Take charge of your financial future today.